What is going on, you guys, and welcome back to another episode of Stock Battles. This is the video series where Mark and I each select a stock of our choosing. We do our research, due diligence, and it's up to you guys to let us know which is the better stock, which one do you like, which one do you prefer. I think we're going to keep this pretty strictly to a 5-minute minimum. You know, we don't want these going forever.
Well,
and for fairness reasons, because you know you like to go really deep into yours and then just to get the vote, right?
Yeah. Okay. So we're gonna have a strict 5-minute time limit on this. In fact, I'm going to take my phone right now. And I am going to put on the timer.
Okay.
Right now.
And we want you guys to vote down in the comment section below which one you prefer, because we do look at those. We do actually tally them up, and that's an indication of which one you guys like. I will just remind you, as always, new start to the year, February, March now. But yeah, if you guys are interested in the Investing Academy, learning about the stock market, be sure to click that link down below, okay?
Are you set?
I've been ready for this.
3, 2, 1. Where you going?
Okay, I'll kick things off, guys. The company that I'm going to be talking about is Brookfield Asset Management, ticker BAM.TO. This is the recently spun off asset manager. And what you're looking at on the screen is the American ticker. It is short, it doesn't provide much value because it's just a recently publicly traded company. But we actually just added this stock in our margin account about a couple weeks back. Just this previous week, I added in my RRSP as well. So I've been kind of back in this stock. It's been a favorite of mine for years. Well, the big company, Brookfield. Nevertheless, we're going to focus in on the asset manager. And BAM is basically a pure play at this point on the asset manager business. They essentially own a 25% interest stake in the asset manager. I should say alternative asset manager, where the other 75% is still left up to ticker BN, which is the big corporation. You can own that as well. But this is like really giving you that exposure to the asset manager. And as you guys may know from our previous videos, this includes all different areas of our world, of the economy. Private equity, infrastructure, real estate, renewables, obviously. Credit is a big part of this. I like to think of this as an asset manager that involves like all types of parts throughout our economy. Very important parts. Here's a quick slide that basically just showcases the breakdown of where this money is allocated, if you will, and the projections of where they plan to go over the next number of years. We're going to look into that in a moment. But what I wanted to highlight for this segment was they raised a record $93 billion in the year. And I think that's pretty impressive, given the challenging environment that we are in. 93 billion? Not bad at all. This is, when we look at 93 billion, this is like the entire asset manager. Again, BAM owns a 25% interest stake in this. Nevertheless, as this company raises more money, there's more money under management or assets under management, their fee-bearing assets and how they make their money just improves. Their fee-related earnings in the quarter were $569 million USD, by the way. And in the year, it generated $2.1 billion USD. And this is an increase of 26% in specifically fee-related earnings. And what I think is just mind-boggling is that this brings their fee-bearing capital, like their total fee-bearing capital, to $418 billion, which is just ridiculous. And that in and of itself is a 15% increase year over year. As that previous slide kind of teased, they hope to grow this number to $1 trillion in fee-bearing capital that they're getting their fees and taking their cuts on. That's about a 20% compound annual growth rate up through 2027. And that's personally what I really like about Brookfield. There's many things that I like about Brookfield, BN and BAM, but essentially this is like that snowball effect happening in real life. And it's like at this point, that snowball is flinging down the hill and it's like taking people out. It's not even just a little snowball. This is like they're fully up and rolling. And why that's important is indicated by that $93 billion, in additional capital raised. I think due to just the prestige, the management of this company, their history, if you will, they're able to just continue leveraging that and amplifying. And it's like a flywheel effect where, hey, these big institutions got big bolts of money. You go to Brookfield to have that allocated for you. So here's a slide. And by the way, not to mention, they're very good at allocating capital. We'll look at some efficiency ratios in a second. But here they state an additional $40 billion in committed capital that they have in committed capital that's uninvested. They believe that this would generate the business approximately $400 million in fees once deployed. Their rough margins on this sits at about 60%. So there's just a lot to like, in my opinion. In terms of the dividend, BAM, so the one that we're talking about today, this is what we may consider the dividend, play of the two companies you could invest in. Ooh, I got about a minute left, I see here. I'll pick it up. But Yeah, they announced this a dividend that a lot of investors were kind of waiting and saying, "Oh, what's it going to be? What's it going to be?" They opted to pay a quarterly dividend of 32 cents USD per share for the asset manager quarterly. That's a yield of about 3.76%. So stellar. Due to the nature of this business, I have no issues about the safety. Payout ratio 37, free cash flow ratio, payout ratio that is 12.3. I would say, although we don't have much data to work off of in this new spun off company, obviously very new publicly traded, we can in this case look back at the business and its history. And historically, this is, like I mentioned, a very efficient company. Return on invested capital for Brookfield at 20%, return on equity, above 30%. They really know what to do with money, and they know these good projects and areas and assets to invest in to generate a return. This is a company that has historically outperformed and actually crushed the market. They're anticipating a 17% compound annual growth rate of the entire business through 2027. I believe with Brookfield, with BAM, obviously you're going to be getting a portion of that in dividends, so not necessarily share growth, but nevertheless, it's just, I've talked about in a couple previous videos, dividends versus share growth and that trade-off you make. This would be a great stock for somebody that does care for passive income. They do care for dividends. And in theory, this spinoff, I think, should unlock additional value. That's what I believe it's already starting to do. But I'm just a big fan overall. I went 30 seconds over time, so we'll wrap it up here. But Brookfield Asset Management is my pick. I don't think you're going to be able to top that.
Oh, well, let's have a look at that. And yes, you're at 5 minutes and 32 seconds of your little speech there. I'm going to ask you to reset that for my time here.
Go!
Because I don't know what part of those I'm going to edit out, but I'll try and leave the whole thing in there. So I'm started already? All right, here we go. So good pick. My pick for this video is Pfizer. Ticker, of course, is PFE, trades on the New York Stock Exchange, currently trading at about $41.71 US. I'm not going to spend a whole bunch of time on what the company does because pretty much everyone's heard of Pfizer. It's one of the middle-sized pharmaceutical companies out there, as you can see by this chart from a market cap perspective. What I like about Pfizer are a lot of things, but I like the long-term perspectives on it, and I think as a perspective, long-term prospects on it, and the attractive valuations that it's trading at right now. Now, the company has declined recently, as a lot of companies has. Question is why. There's a lot of chatter out there that because Pfizer benefited so much from COVID, they're kind of coming back down to earth. Now, I got a couple things to talk about that. First of all, Pfizer started back in 1849, so 174 years ago. I mean, they were around for the Spanish flu, let alone COVID. So I don't buy this argument that we've seen the best of them and they're going away. There is still, in my opinion, right now, as we do this video in February of 2023, a recession looming on the horizon. There's a lot of people agreeing with that. The healthcare space, the defense space. Those are a couple of spaces that are very, very recession resistant. They're going to be used regardless. Of course, Pfizer falls into the healthcare space here. The windfall that the company did get from the COVID boost here was awesome. It's a pro, it's a con, but here's one of the other pros to it. A lot of the professionals are sort of suggesting that the spikes are all over, but this is going to turn into more of a seasonal flu shot type treatment that we're going to be getting to prevent further outbreaks of COVID. So a company like Pfizer will benefit from that. From a corporate diversification perspective, they have 44% of their revenues are coming from their top two brands, Comirnaty and Paxlovid. We've heard those names probably in the last little while. Paxlovid is the treatment. Oh, I'm not going to waste my time answering your questions. Holy cow, the clock's ticking here. From a therapeutic area perspective, let's look at this chart here. We see a very, very well diversified income stream. And let's just have a look at the geography. We think of Pfizer as a large U.S. pharmaceutical company. 35% of their revenues come from the U.S., but then they also have a very strong diversification across the globe as well. Vital to a company like Pfizer is the pipeline. They've always got to have new products coming online. As a result, partly of the boost that they got from the COVID revenue they took in, they've got a lot of ammunition right now. They recently had taken in a $4 billion dividend from the GSK spinoff, Haleon. And as a result of this, they've been going on a little bit of an acquisition spree, which is one of the ways that they are able to add assets. They currently have $22 billion in cash right now. and $51 billion overall in current assets. They've made recent purchases, December 2021, Arena Pharmaceutical, and in October 2022, more recently, Biohaven. So there is lots that they're doing to keep the product online. From a valuation perspective, and this is one of the big reasons I think right now it's a timely time to add Pfizer to a portfolio. They have very attractive valuations, not just one, but a lot. Let's look at a few of those right now. If we look, first of all, at their price to earnings ratio, we see them coming in with a forward earnings ratio of 7.7. Their long-term averages is 15.73. So that looks very attractive purely from that perspective. If we look at the price to book ratio, currently at 2.6, long-term average 3.36, appears to be perhaps undervalued there. And finally here, we're going to look at the price to sales ratio, currently at 3.3, long-term average is 3.72. So yes, not in that metric, not really, really low, but definitely more attractive than their average. If we look at their profitability here, we can see their gross profit margin, 65.9%. Now we compare that to their peers of 56% roughly. And then their gross profit, 66.1 billion, last reported 12 months, and 9.65%. So let's call it a 10% annual compound growth. Dividend, they pay a reasonable dividend. The payout is 3.87% with a payout ratio of 24%. So I'm saying a very, very secure dividend there. From a price target perspective, they're trading, like I say, right now in the $42 range. The price target is an average of 51. So about a 20% upside there. And very quickly, as I wrap up here from a technical perspective, there's a couple of technical indicators that would indicate that company may be oversold. First, let's look at the RSI. We can see that level has been bouncing down at that 30 oversold level for a little while now. So who knows, that might say look at something. And if we look at the Bollinger Bands to wrap things up here, we see it trading again at the bottom of that range. So that's about two standard deviations from the norm. So again, indicating that there might be some upside potential there. You got a brand name leader here in a company like Pfizer, right? You've got high margins, you've got future prospects in that pipeline. Trading at a discounted valuation right now. I see him at 5 minutes and 32 seconds. So I got to wrap it up here. My pick for this stock challenge is Pfizer. So now we got BAM, we got PFE. We're leaving it up to our viewers to say, what would you buy in a portfolio right today? So
I will say, it's a sly move. You go for a company that is in cahoots with the government. You gotta pull out all the stops. I mean, even I can't really argue with that.
This is a battle, okay?
Yeah, you do usually pull out the stops. I will bring it back to one thing that I think you mentioned as well is, although the markets have been on a run as of recent, really bounced off the recent lows a lot. Yeah. I don't think we're necessarily out of the woods yet. I think it's early to say that, and you do say there is still this, recession threat ahead.
Right.
It's a good point that companies like this or the defense sector would stand well. I think Brookfield almost, not to slam my pick. I don't want you guys to change your decision, but that would be.
Listen carefully to this part.
It could be it could be looked at as the opposite, especially with the real estate assets and certain areas of the economy possibly being hit harder and a more troubled space to be in. I would just say that's one thing besides the government cahoots that I would lean in your favor.
Oh man, you should be a trial lawyer, Brandon. Okay, good. So those are our picks. And I kind of like this more it's sort of time limited, and it's tough for me because, like, with those of you who've ever watched,
you did good though. You made it. You did exactly my time, 5:30 each. So.
I didn't even rehearse it, so I was kind of, but we kind of snuck a little bit over there. So let's wrap it up there, Brand. Thank you to all for watching, and put your votes in now. We'll come up with a method to sort of report those, maybe in the next stock battle, which we look forward to doing soon. And anything else to say?
I would just say, as always, leave a thumbs up. Like I said, leave a comment, subscribe if you're not already subscribed, and then check out the Investing Academy. If you like courses and training, don't forget to do that. That is that link down below. But with that said, I think we can wrap up. Good battle, fair battle, I would say. I'm anticipating a pretty even
response.
Yeah,
voting.
Pretty even vote down here.
Sounds good. Thank you, everybody, for watching. We'll see you in the next video.
Bye.